In today's economic climate, working hard is no longer enough. Prices continue to soar. Inflation relentlessly eats away at the value of your money, and what once felt safe, pensions or savings accounts, are becoming increasingly uncertain. Middle-aged Americans are facing a tough question. What's the best way to make my money grow without working for it the rest of my life? The answer lies in smart investing. By the end of this video, you'll walk away with 4 powerful investment options, safer than you might expect, and, most importantly, they don't require a lot of time or effort to manage.
1. Dividend income from blue-chip stocks. Are you 35 or older and starting to think seriously about your financial future? Maybe you've spent decades working hard, saving diligently, and doing your best to ensure you won't have to rely solely on Social Security in retirement. But the truth is, hard work alone is no longer enough. The cost of living keeps rising, inflation continues to eat away at the value of your money, and pensions, if you even have one, are no longer the safety net they used to be. One of the most stable and effective solutions that many middle-aged Americans are turning to is investing in dividend-paying blue-chip stocks. This strategy not only helps grow your wealth over time, but also creates a steady stream of passive income, ideal for those seeking a second paycheck in retirement. A consistent income that you can either reinvest or use to cover monthly expenses. Blue-chip stocks are shares in large, well-established companies with strong financials and a long track record of success. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble are prime examples. These are trusted household names, known for reliable products, but what they also have in common is their consistent dividend payouts, even during recessions or market downturns. The beauty of dividends lies in their reliability. You receive a cash payout, typically quarterly, regardless of whether the stock price goes up. This is exactly why so many middle-aged investors favor this asset class. Instead of having to sell shares to generate cash, you can hold your investments and still receive income. For example, if you invest $100,000 in a portfolio of dividend stocks with an average yield of 4%, you'd receive roughly $4,000 per year, more than $330 per month. That money could cover your bills, help with living expenses, or be saved for the future. Even better, dividends can increase over time. Many blue-chip companies have a tradition of raising their dividends each year. That means your income has the potential to grow, helping you keep up with inflation. Compare that to a traditional savings account, which often yields low interest and can't keep pace with rising prices, causing your money to lose value over time.
Another reason dividend stocks are a smart choice for people in their 40s, 50s, or 60s is the stability and reliability they offer. At this stage in life, you're likely looking for safety rather than risky short-term gains. Companies like Coca-Cola and Johnson & Johnson have weathered decades of economic cycles and still managed to grow their earnings. That kind of track record gives you peace of mind when investing for the long term, without the stress of day-to-day market volatility. If you've never invested in stocks before, don't worry. It's easier than ever to get started. Today, there are trusted online platforms like Vanguard, Fidelity, and Charles Schwab that allow you to open an account and begin investing in top-tier blue-chip stocks with ease. And if you don't have the time or expertise to handpick individual stocks, Dividend ETFs are a great alternative. These funds track a basket of high dividend-paying companies. With just one transaction, you gain exposure to a diversified group of solid businesses, and you still get regular dividend payouts. That said, like any investment, dividend stocks are not entirely risk-free. It's important to watch out for stocks with unusually high dividend yields. Sometimes a high yield is a red flag, signaling that a company is in trouble and its share price has fallen sharply. That's why it's smarter to focus on companies with a long history of consistent and growing dividends, rather than chasing the highest yield. And always remember the golden rule of investing. Diversify your portfolio. Don't put all of your money into one or two stocks, no matter how attractive they may seem. Spread your investments across different sectors, or use ETFs to help allocate your funds more wisely. In summary, investing in dividend-paying blue-chip stocks is one of the simplest, smartest, and most sustainable ways for middle-aged Americans to generate passive income. With the potential for steady, growing cash flow, this asset class deserves a place at the heart of your long-term financial plan, whether you're preparing for retirement or simply want your money to work for you. If you're looking for an investment option that offers both safety and consistent returns without constant oversight, dividend stocks may be your answer. This isn't just an investment, it's your second paycheck, and this time, you're in control.
2. REITs, Real Estate Investment Trusts. By middle age, many Americans begin to take a serious interest in real estate as a way to generate steady passive income. However, not everyone wants or is able to deal with the responsibilities that come with directly owning and managing rental properties. Things like maintenance issues, collecting rent, or handling legal disputes with tenants can quickly turn into a full-time job. If you're looking for a simpler path to benefit from real estate, REITs, Real Estate Investment Trusts, might be the ideal solution. REITs are companies that invest in income-generating commercial properties such as shopping malls, office buildings, hotels, healthcare facilities, or logistics warehouses, a sector that's booming with the rise of e-commerce. Instead of putting down hundreds of thousands of dollars to purchase a property outright, you can simply buy shares of a REIT, just like buying stock. This makes real estate investment far more accessible than ever before. One of the biggest draws of REITs is their ability to provide consistent passive income without requiring hands-on involvement. By law, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. That means you, as an investor, can receive regular income without ever having to manage a property or deal with the day-to-day headaches. No broken pipes to fix, no late rent payments to chase, no midnight phone calls, and yet you still share in the profits from the growth of the real estate market. REITs also offer a high level of diversification. Instead of sinking your entire investment into a single apartment or building, when you invest in a REIT, you're gaining exposure to dozens or even hundreds of properties, stretching from New York to Los Angeles, spanning everything from hospitals to data centers. This diversification helps reduce risk and optimize returns. If a few properties in the portfolio underperform, the gains from others can make up for it. Liquidity is another major advantage. Unlike traditional real estate, which can take months to sell, shares in REITs are traded on major stock exchanges. You can buy or sell them easily, giving you the flexibility to adapt to unexpected expenses, medical needs, or changes in your retirement plans. Then there's the issue of cost. Buying and managing a rental property can come with hidden and ongoing expenses, maintenance, property taxes, management fees, and more. In contrast, investing in REITs usually involves much lower and more transparent costs, making it easier to manage your cash flow. Plus, many modern REITs focus on fast-growing sectors like data centers, 5G infrastructure, and e-commerce warehouses, creating long-term opportunities for growth and income. Here's a simple example. Suppose you invest $50,000 in a REIT with an average dividend yield of 5%. That could generate around $2,500 per year, over $200 a month in completely passive income. This money could help cover your monthly expenses or be reinvested for future growth. Of course, like any investment, REITs come with risks. Share prices can fluctuate with the market, and dividends are not guaranteed. But with a strategy that prioritizes REITs with strong fundamentals, a proven track record, and a diversified asset base, you can confidently hold them for the long haul. In summary, REITs are a compelling option for middle-aged investors who want exposure to real estate without the stress of managing it. With consistent passive income, high liquidity, broad diversification, and low overhead, REITs not only meet your financial needs today, but also lay the foundation for a stable and sustainable retirement plan. If you're seeking a balance of income, growth, and peace of mind, let REITs do the heavy lifting so your money can work for you.
3. Income ETFs. Simple, steady, and smart for busy midlifers. By the time you hit your mid-30s or 40s, both your time and energy start to feel more precious. That's when many Americans begin to look for investments that are not only safe, but also capable of generating steady passive income without demanding constant attention. Income ETFs, exchange-traded funds, offer exactly that, a smart, balanced way to invest that delivers both stability and long-term cash flow. They're especially ideal for people who aren't financial experts and don't want to spend hours analyzing the market. An ETF, or exchange-traded fund, is essentially a basket of investments. A single ETF can hold dozens or even hundreds of different stocks or bonds. Income ETFs specifically focus on assets that generate regular cash flow, such as high dividend stocks, government bonds, corporate bonds, or even REITs. Instead of having to research and buy each individual stock or bond yourself, an income ETF gives you instant diversification and professional management, all in one easy purchase. One of the biggest advantages of income ETFs is risk reduction. When you invest in a single stock, you're vulnerable to anything that affects that company. But with an ETF, your money is spread across many assets, minimizing the damage any one underperformer can do. This makes income ETFs a smart capital preservation strategy, critical for anyone focused on long-term financial stability. Another major benefit, accessibility. Platforms like Vanguard, Fidelity, or Charles Schwab allow you to open an account and start investing in minutes. With low trading fees, clear fee structures, and no large capital requirements, ETFs are a favorite among middle-aged investors who want a set-it-and-forget-it option. You can even automate monthly contributions through retirement accounts like a 401k or IRA. No need for daily market tracking or complex decision-making. But perhaps the most appealing aspect of income ETFs is the consistent passive income they can generate. Many of these funds pay out dividends quarterly or even monthly, giving you a reliable stream of cash to supplement your salary, Social Security, or retirement withdrawals. For example, well-known dividend ETFs like the Schwab U.S. Dividend Equity ETF, SCHD, or Vanguard High Dividend Yield ETF, VYM, currently yield between 3 to 4% annually. That can go a long way in covering monthly expenses or funding additional investments. Income ETFs are also perfect for people who are busy or simply not interested in digging into PE ratios, earnings reports, or macroeconomic data. These ETFs are typically built by seasoned professionals using time-tested strategies aiming for consistent performance over time. If your goal is to invest once and let it ride, income ETFs are a powerful way to let your money grow while you focus on family, health, or other life priorities. Liquidity is another key selling point. Unlike real estate or annuities, which can take months or even years to cash out, ETFs can be bought or sold on the stock market at any time. So if life throws you a curveball, you'll have quicker access to your money when you need it most. And it's not just for beginners. Financial experts frequently recommend income ETFs as a core part of a well-rounded retirement portfolio. With their unique blend of capital preservation, income generation, and flexibility, income ETFs are a proven way to weather economic uncertainty and stay on track for your financial goals.
If you're 35 or older and searching for a simple, reliable investment that fits your busy lifestyle, income ETFs deserve a serious look. Think of them as your second paycheck, a dependable, passive income stream that works quietly in the background, helping you move toward financial freedom with peace of mind. Let your money grow without it growing into a second job. Income ETFs can help you protect your wealth, generate real cash flow, and simplify your path to a secure retirement.
4. U.S. government bonds, the bedrock of a safe and stable retirement. As we move into midlife, our financial priorities begin to shift from aggressive growth to capital preservation and steady income. That's when U.S. government bonds, including Treasury bonds and I-bonds, emerge as essential tools in a low-risk, income-generating portfolio. Backed by the full faith and credit of the U.S. government, these bonds offer unmatched security, making them ideal for anyone preparing for or already in retirement. What makes government bonds so reliable? Simply put, you're lending money to the U.S. government, one of the most credit-worthy borrowers in the world. The risk of default is incredibly low, especially compared to stocks, which can swing wildly with market sentiment, or corporations which can go bankrupt. Government bonds offer peace of mind. They aren't tied to the ups and downs of the stock market, making them perfect for those who want consistent income without dipping into their principal. One standout option right now is the I-bond, a type of savings bond specifically designed to keep up with inflation. As prices rise and cash loses purchasing power, I-bonds adjust their interest rates every 6 months based on the Consumer Price Index, or CPI. This means your investment grows in real terms, helping you maintain your lifestyle even in uncertain economic times. I-bonds have become a go-to safe haven for investors during periods of high inflation or economic instability, offering inflation protection without the need for complex strategies or active management. If you're looking for predictable income, long-term Treasury bonds are another solid choice. These bonds pay fixed interest, typically every 6 months, and are excellent for building a dependable income stream in your retirement years. On top of that, the interest from U.S. Treasury securities is exempt from state and local income taxes, which can be a huge benefit if you live in a high-tax state. Investing in government bonds today is easier than ever. You can buy them directly from the U.S. Treasury. No brokers, no commissions, and a user-friendly interface designed for both beginners and those not particularly tech-savvy. You can track your investments day by day, all from one secure platform. Government bonds also play a critical role in diversifying your portfolio. If you already own stocks or real estate, bonds can act as a stability anchor, softening the blow during market downturns while continuing to provide passive income. This balance between growth and safety is key as you transition toward retirement. If you're looking for an investment that offers absolute safety, consistent income, and freedom from market volatility, U.S. government bonds are a smart and timeless choice. They not only protect your purchasing power, but also support the lifestyle and financial freedom you've worked so hard to build.
The 4 income-generating strategies we've covered, dividend-paying blue-chip stocks, REITs, income ETFs, and U.S. government bonds, each serve a critical purpose. Together, they can form a powerful, low-maintenance investment portfolio designed to deliver steady, passive income while preserving your wealth. These are not just theories, they're trusted strategies already helping millions of people maintain their lifestyle, safeguard their savings, and keep pace with inflation. If you found this video helpful, don't forget to like, subscribe, and share it with friends and family who are also entering this new phase of life. The journey to financial peace of mind doesn't have to be lonely, and it's never too late to start.